This is Matthew Kratter from Trade University, and today I want to talk about some utterances from the US dollar high priest, which is Jerome Powell. Yesterday was another Fed meeting. The dice were rolled, chickens were sacrificed, and the money gods were asked to reveal their will. And unfortunately, the result was not good, and the markets did not like it. We got a huge sell-off. And the key language in the Fed statement was this phrase here: even so, we still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. And he did moderate this by saying our decisions will depend on the totality of incoming data. But the market took this as a very bearish statement. And then from the press conference, we have a couple quotes here from Timaraos. I don't know if I'm pronouncing his name correctly, but he's become sort of the current oracle of the Fed. This is from Powell from yesterday's press conference. The question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive. And then there was a couple risk-reward statements, which were interesting, that Nick reports on. Powell said the risks are asymmetric. If the Fed does too much, it can cut. If it doesn't tighten enough, then you're in real trouble. Now, the problem with this is when you're talking about the Fed doing too much, we're really talking about regular people's lives and their livelihoods. I like this quote from Ben Rickert in the movie The Big Short, the Michael Burry movie about the collapse of the U.S. housing market and how it almost blew up the U.S. banking system. And this is a role played by Brad Pitt. He plays former investment banker Ben Rickert. And the famous quote is, for every 1% employment goes up, in other words, the employment rate goes up, 40,000 people die. And this is what's often missed when you see very plain neutral talk like the risks are asymmetric. If the Fed does too much, it can cut. Well, it's not going to, if the Fed over tightens, and it has already over tightened, this is not going to bring back people who've lost their businesses, people who've lost their portfolios, and people who have died because of a higher unemployment rate. But central bankers don't care about this. Isn't it amazing that a few incompetent, unelected bureaucrats get to decide not only the cost of money and the supply of money, but also whether people will live or die? And here's the real problem. The yield curve is already telling us that the Fed is too tight. The damage has been done. They've already over-tightened, and the 2s10 spread, in other words, the yield on the 10-year Treasury minus the yield on the 2-year Treasury, widened to even a larger inversion, now inverted by almost 54 basis points. And so what's really happened is the damage has already been done. The car has been driven off the cliff, and now we're just waiting for the lag in monetary policy and waiting to see the car crash down. This was definitely the most hawkish FOMC statement and press conference of the year. Powell didn't even throw the stock market a bone, and so stocks and other risk assets sold off quite sharply, with the one exception of Bitcoin. Bitcoin did sell off a bit, but I think what's been quite interesting is how well Bitcoin has been holding up. And it's almost like the last honest free market in the world is looking ahead and already trying to discount a more dovish Fed. And we see this if we look at Bitcoin versus tech stocks, Bitcoin versus the QQQs since the beginning of September. Bitcoin is relatively flat, just up a half a percentage point, and tech stocks are down 11%. So Bitcoin definitely holding in much better. And those people who say Bitcoin is just another tech stock, this shows that they're actually quite different assets. It's also interesting to look back and see what Bitcoin was telling us when it peaked. And of course, we only know these peaks in retrospect, but Bitcoin peaked on November 8th, almost a year ago in 2021, and then basically signaled to us how aggressive the Fed was going to be. It began to price in tighter monetary policy before anything else did. The NASDAQ and the stock market really didn't peak until a couple weeks later, and it sort of chopped around sideways at the highs. Now we're continuing to see 2-year yields move up, which gives the Fed room to continue to hike. So the 2-year note currently hitting 4.73%, and the market is pricing in. So the current Fed rate is 3.75 to 4%. That's the Fed funds range. And the market is currently pricing in approximately a 50% chance of a 50 basis point hike from here and a 75 basis point hike from here at the December 14th meeting, which will be the last meeting of the year. So definitely pricing in more Fed tightening to come. And as I've been saying, I think there's an increasing chance that Fed policy at this point has more to do with geopolitics than the U.S. economy. When I look at how inverted the yield curve is here and what Powell is doing, it makes absolutely no economic sense. Inflation is still high, but it's more a function of high energy prices and having printed so much money over the past few years. And unfortunately, the U.S. economy is in a place where the Fed should not be tightening this aggressively without first bringing down debt to GDP levels, because the problem with the economy still being as overlevered as it is everything begins to blow up when you tighten this aggressively: housing, stocks, and other risk assets. So that's why I've been saying that I think there's an increasing chance that what we're seeing here has a lot more to do with geopolitics than the U.S. economy, and that the Fed has somehow been co-opted by the U.S. military and by the State Department. Is the Fed hiking rates to crash crude oil and thus hurt Putin's revenues, or maybe to have revenge on the Saudis for their recent diplomatic snubs? Or is the U.S. somehow weaponizing the U.S. dollar against China through higher rates? It's hard to tell. Only time will tell. But I still think that we will see a sharp reversal, especially if the money plumbing pipes break, if the Treasury market breaks, and we start seeing some illiquidity there, as we did in March of 2020. And that would give us a situation very similar to what happened in the Bank of England in the UK, where they said they were going to continue to hike because inflation was very high. And then the pension market started to break, the gilt market started to break, which is their government bond market. And even with inflation at 10%, the central bank, the Bank of England in the UK, pivoted and started buying bonds. And as soon as the Treasury market breaks, or we get some other large market like that breaking, and I don't think it's going to be stocks, it's more the Treasury market that the Fed's worried about. Once we see that, the Fed will pivot, pause, or turn the money printers back on. And it doesn't matter if inflation's still at 8 or 9%, because this is really what they're trying to do. And as they made very explicit in Nick's quote here, if the Fed does too much, it can always come back in and mop things up. This is how the Fed always operates, unfortunately, not paying attention to the lives that it's hurting. Obviously, high inflation hurts people too. It disproportionately hurts the middle classes and working classes. But unfortunately, we're at a point where the U.S. economy has no good choices. And what we should be doing is letting inflation run hot, and inflate our way out of our debts before we try to normalize interest rates. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.